Obviously, 2022 has been a challenging year for investors thus far. As of the close of business on Thursday, May 5th, the Bloomberg Aggregate Bond Index is down approximately 10%, and most broad-based stock indices are down a bit more than that. Factors such as the uptick in COVID cases, lockdowns in Shanghai, rising inflation and interest rates, the war in Ukraine, and the withdrawing of the stimulus measures put in place at the onset of the pandemic to support the markets and the economy have combined to put downward pressure on stocks and bonds simultaneously, limiting the usual benefits of diversification and giving investors few places to hide. From our perspective, the good news is that all this bad news is largely priced into the markets. Many economists and analysts are anticipating an economic slowdown and perhaps even a recession later in the year, as the Fed raises interest rates to try to curb inflation and slow the economy. Stocks have traded down accordingly. Likewise, rising inflation and interest rates triggered a decline in bond prices. Our expectation right now is that bond prices will soon bottom out and stabilize, and once again bonds will begin offering the downside protection against risk and volatility that we expect. Stocks will likely see continued volatility in the months ahead until some of the headwinds, inflation, the war in Ukraine, supply chain disruptions, etc., recede and the economic outlook clarifies and begins to brighten again, setting the stage for future economic growth and the next upturn in the market. As always, if you would like to discuss your portfolio and your financial situation in more detail, please feel free to get in touch. In the meantime, we will continue to monitor your investments and be in touch if we think any changes are warranted. Thank you.